Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Podcast. We are live tonight, and we're so happy to have you join us. Happy holidays. I hope that you guys had a great Thanksgiving week last week, and as we're just cruising right along now. And it's interesting because depending on who we're trying to get a hold of this time of year, people just kind of go absent, I think, for the next month. Mm-hmm. So it's a good time that we kind of focus in on our business and our clients and our families and friends, and we just kind of huddle around and say thank you guys for being a part of our year. And we've got a really exciting show tonight, talking about the home buyer's mindset. And we have just been, the home buyer has been really on this roller coaster ride for the last 2 years. And unfortunately hasn't gotten much better, depending on what your tolerance is for going up and down. And tonight we got Alyssa Glutz. Alyssa is a return contributor. Alyssa is amazing. I think the last time that we had Alyssa on, we had technical issues, and maybe it was, I don't know, Alyssa, maybe we podcasted twice together so far. But at one point, I think it was our first time podcasting together. We were kind of new at this thing, and my internet went out, and I think you were like, uh-oh, what do I do now? But anyway, we're joined with Alyssa again tonight. Guys, there's a question out there whether I should grow a beard. I wanted to shave tonight. Alyssa said absolutely not.
No, definitely not. We're going to grow it the month of December.
We had this little competition. We'll share it with you all today at the office. It got really kind of real. Melissa, do you want to explain it?
Sure, I can explain it. So Todd has been growing this beard for, the past week. And it's growing. And I was like, this is great. We're going to have it grow in. We're going to see where you are end of December. And he said, I'm going to put a poll up tonight. We're going to say that you're going to have to, first it was cutting your hair to above my shoulders. I said, absolutely not. And then he said, we're going to dye it. And then he's picking out colors. Who was the YouTuber you were pulling from with the green hair? Me Kevin. Thank you.
Shout out to Me Kevin. Yeah. He had red hair.
Red hair.
He had tennis ball yellow.
I am like, I am not doing that. And he's like, well, the viewers will tell us what's going to happen in the future. And I said, I don't know. So,
but then I said, you know what? And then I said that they like you more, and they will make me grow a beard before they make you dye your hair. I'm sure of it. I don't know. Who knows? Stay tuned, guys.
Knows?
But then there was one of our agents said, well, Todd, that's not really fair to dye Melissa's hair and just have you grow a beard. So then there was the thought that I would just grow a beard for a month, and then we would have the competition, and whoever lost, I'd either dye my beard tennis ball yellow.
Yes.
Or Melissa would dye her hair tennis ball. Anyway, enough, guys. Welcome to our show. Alyssa, introduce everybody. You're coming from Arizona tonight.
Scottsdale, Arizona. Yes. And I know all about dyeing hair. I've had like every color hair in the last 3 years. So this is my natural, besides a lot of gray. But beyond that, my dark hair.
Well, tell everybody about you.
Okay. I'm a 45-year-old mama in Scottsdale, Arizona. I've been a mortgage loan officer now for 20 years. I wrote a book about 7 years now called Color My Credit. And it isn't credit repair. It's my own method. It was my own way of explaining to my own customers, my own clients, how to get from a dream in your heart to owning a home. That path is so much about the mindset, but credit is such a big piece of it. So credit is my area of expertise. And I wanted to basically simplify it enough to a point where you felt like this is something I could do. I could actually maybe improve my credit, build, rebuild, whatever the need, or just make it better, go from good to great, but whatever you could do. So I saw a lot of credit repair options as a loan officer, and I didn't like a lot of them, because they were focusing on the repair, and it's mostly about the rebuild. And so anyways, I've been super focused on teaching the right credit education, credit empowerment, the last 5 or 6 years on top of my business.
Yeah, it's amazing. And you've helped a lot of people. And guys, check her out. We also have an amazing video on Sachs Realty's channel. If you just search for it, put in Alyssa's name, and a lot of helpful tips on, great nuggets on how and when to pay your credit cards and stuff like that.
Right.
And it is a matter, when we're talking about, especially in the time that we're going right now, where debt is expensive, credit report is extremely important. Your scores, very important. A lot of people out there do want to buy a house. And, we're going to talk tonight. We're going to show you some interesting stats, guys, that just came out. Brand new published stuff. We're going to take a look at consumer debt, the breakdown of the consumer debt, where it's primarily, concentrated, and, what kind of relief, where are we going to come through this? There's so much going on right now.
Yeah.
Melissa, say hello to everybody.
Hi, guys. Hi, everyone. Hi, Alyssa. So awesome having you back again.
Oh, I'm
Thank
so
you
glad.
so much. Yeah. So, I think it's very timely that we have you on here. We're dealing with buyers. We're dealing with the consumer debt, which Todd just said, and people need to, get ready, and you help them with that. So I know you're going to have some great tips that you're going to talk about later in the show, but we are so happy to have you. And you guys, please give questions, comments. I'm going to be going through them and, letting everyone know what's on your mind, and we'll have Todd and Alyssa, chime in.
So Alyssa, we can kind of start off. Want to ask you some critical questions, obviously, kind of dive into, guys, so that you understand, a loan officer is kind of like the first step in the process of buying a home. And, we know what's happening, right? Prices crazy high on houses. And now all of a sudden we've seen the quickest increase in interest rates. Alyssa, I'd like to know your opinion.
Yeah.
Has the Fed made a mistake in the, should they have done it before, sooner, to slow the house prices down? But now that they didn't, have they gone too fast? Do you think they're going to back off? Just kind of give us an overview of where you think J-Pal and company is taking us as far as interest rates, which ultimately, even though it doesn't directly affect it, it spills over and equates to higher mortgage rates. So can you just kind of give us your opinion on that?
Well, it's been, I was saying a few years ago, in the middle of 2020, when I started seeing a lot of the homes by a lot of the iBuyers, the Open Doors, the Zillow, that were buying up, they were fire buying, right? And I knew that eventually it was going to be coming, turning the other way to being the fire sale, too. And I bring that up. I guess my, what I want to say is, I don't think anybody out there, no matter how much you study, could predict exactly what's going on right now and how fast things turned around. I did a loan for my ex-husband, and at the beginning of March, we locked in at 3.25. By the end of the month, it was 5.25. And for him, that was a $500 difference in the $425,000 house he was buying. And he was already kind of like, wow. But at the time, I saw a lot of people continuing to move forward based on the fact that there wasn't a great alternative. Rental prices were going up as well. So, you might as well buy a home, right? But as far as interest rates go, to get to your question, I don't know where he's going. I do, in my opinion, from what I've seen, I wish they would have started a little earlier. I think they were 4 or 5 months behind. But what I see happening, and what I watch a lot of different analysts out there, what I see happening is that we're starting to see a turn right now where I think that the rates will be probably in the high 4s, like low 5s in that first quarter of 2023. And then I think in 2024 is when we're going to start maybe seeing them back down in the 4s again. But we've created a lot of solutions. I mean, through some of the loan programs, like through what we're going to talk about tonight, but the 3-2-1 buy down, where today I was quoting somebody where the rates are at 6.625 on a 30-year fixed. This 3-2-1 buy down, that means for the first year, they're starting out at a 3.625. And then they're going to a 4.625, kind of easing into the payment if they don't refinance before then. So there's a lot of ways to still make it affordable. But what I see interest rates, here's the thing, whether I've never really been driven that much, by the interest rates. I even bought my own house. And when I bought my house a few years ago, I got a 12% interest rate because it's a long story, but at the last minute, I said, I'm getting a house, right? And I ended up refinancing it about 3 years later down to 1.875 at the lowest, point. But the house value went up for $500,000 over the last couple of years. I mean, after out of the last, 6 years. So, I wouldn't have wanted to pass that up. So, of course, it's got to be affordable for you, but the rates are going to come back down. I believe, like right after the first of the year, you're going to start seeing some breaks. We're already seeing a little bit. It's gotten a little bit better since that's not a very technical answer, but
yeah. Well, what do you think about the fact that we saw the highest home price appreciation? I mean, and I hear the argument all the time, back in 1983, I had 18%, mortgage rate. I mean, houses were 45 and
14,000. Yeah.
I mean, it's not, I think the situation that we had, and I tell you, I wish I shared your sentiments. I mean, I love you. I mean, I think that,
you think where the rates are going up, huh?
I think they're going up. Yeah. I think if I had to sort of formulate my thought here, I think that, rates, it would be amazing if Jay Powell did an about face. And the reason I say that is because we're in such, disarray, overall. And we'll dive into that because I have some pretty interesting things I want to talk about tonight. But with the rate of appreciation, historically, for our economy to do well, we need sort of, deflation. We don't need inflation. We need some deflation, right? Because our jobs, primarily, people aren't making enough money to pay for the prices that is happening today. So either, I think two things are going to happen. I think either we're going to see a major crash in home prices, which I don't know that we're going to see a major crash in home prices because of inventory. We talked about that. Or we're going to see sales just flatten out for a long period of time until something happens. And I think that something is either going to be wage growth or, a combination of that and mortgage rates or just interest rates in general coming down. But no, I don't think we'll be I could be 100% wrong. And I hope you're right. And I hope I'm wrong. But I think that we are going to see interest rates stay right about where they are, cruising right into the new year. And these buy down products that you're talking about scare me to death, or at least these,
why do they scare you though? Yeah.
Because I don't think that people are going to be able to refi in 3 years, because two things have to happen. And again, respectfully speaking,
right.
I think that if home prices are not going up from peak for quite some time.
Right.
So now let's suppose we have a 10% adjustment nationwide. Right. Maybe we're 5 to 7% right now locally where we are on average. Let's say nationwide, we look at a 10% price reduction. The problem is people haven't put enough money down. So two things have to happen. Home prices will have to stabilize at that point, hoping that we do not have foreclosures. We have no more inventory. Airbnb people don't go out of business, right? all this extra housing inventory that we're missing would
Mhm.
have to not go on the market,
Mhm.
or home prices are going to have to stabilize or increase in value, or how are they going to
Refi.
refi with
The loan programs.
appraisals?
Yeah, the loan programs, though, the ones that have an FHA loan, when they go to refi, they can do a streamlined refi. They don't need an appraisal. Now, also, after the last housing crisis and the crash, a lot of loan programs were available through HARP. If you remember those words, HARP, HAMP,
Mhm.
those allowed, they didn't look at the value either. They looked at the benefit of dropping the
Mhm.
rates. And the other thing I don't see.
But that was in an appreciating market.
No. I mean, the market was tanking. I mean, it was part of it.
You're
was
talking about pre-08?
like the relief. Yeah. This was after, after as '08 was happening, they did the HARP program and other programs that allowed you to still
But
be able to
interest rates were
refi.
low.
Yeah. But the other thing
Comparison.
is about the buy down program. Okay. The one thing is I didn't like it at first because I thought, why wouldn't they want to take this 2.25% typically that the seller's going to contribute and use that as buying down their rate or using it for their cash, for closing or whatever the case, But the nice thing about these buy down programs is if you decided to refi next year, you didn't lose all of that money. It goes into a separate fund where the money comes out of that account, basically to cover the difference between what you would pay at a 6.6, versus the 3.6. But if you refi next year, the balance that's left over in your account that hasn't been used yet gets just reduced from the principal balance. So you don't lose that money.
So let me
But
ask
yeah,
you a
you do have
question.
to have the ability to refi. Yeah.
While you're on this path, okay, because this is a valid question. I think a lot of people want to know.
Yeah.
What is the percentage difference of a interest rate that becomes where it makes sense
Okay.
to
Mhm.
refinance?
So at 400,000, okay, let's say about a 1% difference is about $200 in the monthly payment. Okay. You always want to look at what your total costs are that are going to be basically, and don't just look at your estimates and breaking out the costs. It can get very confusing. What was your payoff and what's your new loan amount? Okay. And deduct that to find out how much are you increasing your loan balance, right, to save. So if you're going to save if 1% and your loan amount's about 400,000, that's $200 savings a month. Divide that by what the costs are to figure out exactly how many months it's going to take before it really starts saving you money. Mm-hmm. If you refinance, but your plan was just to end up selling in a couple of years, you might not want to refinance. You might want to just look at what it is just to continue with the rate you have. But I do think the mental piece is big. Because, I kept thinking to myself, wow, so 1% difference in the rate on 400,000 and that being about a $200 difference in the payment. However, if somebody has a 620 credit score versus a 720 credit score, and they're putting the same amount down on a $400,000 house, that's about a $400 difference in the monthly payment right there. So, and I've seen a couple people that started out at the beginning of 2020, found me on TikTok, had a 550 credit score. One specifically I'm thinking of that just closed on his house in Minnesota last week. And he went from a 550 to a 760. He doubled his income the last couple of years. The big thing is he hedged this whole interest rate increase because overall, he was only about $70 more on the same house price as where he was when he had the low credit score and he was going FHA back in 2020. $70, where another, if he would have done nothing with his credit score, just sat in the pity for a few years, and then got to this point and bought, it was like almost $900 difference in his monthly payment if he would not have raised his score. But $70, he was like, okay, this is not far off of what I was expecting.
Yeah.
That's
so
huge.
See, guys, that's credit score, right? I mean, out of everything that you're hearing right now so far,
credit score.
On credit score. Keep your credit
Here's the thing too, and I've done this story a million times, but I call it debt pinball. And my mom's fine with me talking about it a little, but several years ago, my mom said, I have like 25,000 in credit card debt. It's kind of always been that way. I mean, I have about 8 credit cards. I'm making about a $1,600 payment towards every month, and every year at the end of the year, I'm not really any lower. And it was the first time I really looked into what a minimum payment is. And it's funny how we just don't learn that growing up. But that I always thought a minimum payment was the minimum payment you could make to not be late, and mostly going to interest, but a little bit towards principal. I heard that. That's not true. And so a minimum payment is usually based on 1 or 2% of your balance that you owe. So for example, let's use 10,000. You owe $10,000. Your 2% of 10,000 is $200. That's what your minimum payment is. Some people go, I'm going to make a $210 payment, whatever the case, right? But let's just say that the interest rate on that 10,000 is 24%. Okay, 10,000 times 24% is 2,400. Divided by 12 months is $200 a month, which means any higher of an interest rate on that credit card, you aren't even paying enough interest to cover what you owe. The rent fee for being in debt another month did not actually pay them. So now you owe more. Without using the card, you owe more the next month than when you started. Do you get it? So when I see people making credit card payments versus doing what my mom did, which is I told her to go over, get an installment loan. Those don't impact your credit score. They almost look like if you took the personal loan you got from Lending Club or from your bank or from Upstart, that was like a 3 or fixed 5-year loan, fixed term. They give you 25,000 cash. My mom's payment was like $809 on a 3-year loan. So she got the cash. She immediately paid all the credit cards off and set them up just to have like a $20 charge each month, just to discipline, just to show that she is demonstrating that she could have borrowed 2,000, but she borrowed 20 with these revolving accounts. Then the one installment loan started reporting, just one payment. Her scores, never been late in her life, but all of her credit cards were maxed. So she was used to being in that 660, 680 land. Well, a month later, when the credit cards updated, she went to 760. So immediately she was like, you know what? Now that I have a 760, I can refi my car. I can refi my house. I can get cheaper car insurance, cheaper home insurance. Saves her another $500 a month in her bills, her credit score now. Now she adds that $500 onto the $1,600 payment she was originally making. It was only an $890 payment for 3 years. So she was debt free in 9 months. 25,000 gone in 9 months. And in the best place possible. And so you have to mentally, that's what we have to do. It's very hard to grasp the thought of having a $3,000 house payment. But I'll tell you what you do have. You have a $2,400 rent payment. You have a $600 car payment. You have a $300 storage unit payment. You have all these things that when you add it all up, I mean, you see that there's nothing more expensive than being broke. It will just add on.
We're going to show a chart here soon. Not yet, but we're going to show you just how broke we are. Oh, man.
We got to get creative, though. That's my point. We got to color. We got to get creative.
Go through the pain before we get the fun.
That's right.
Let's take some questions.
Mm-hmm. How about we start with this one? How damaging is a credit hard pull? Can it be removed? Why must it stay on record for 2 years?
Yeah, that's what's crazy. People put way too much weight on hard inquiries. And did you know that there's only like 13% of consumers who shop around specifically because they don't want multiple hard inquiries? Mm-hmm. And there's mortgage lenders out there that will tell you, you can pull your credit by several lenders in 45 days, 30 days, 15. Everybody's given out different time frames of how many times you can have a lender pull before it's considered more than one hard inquiry. The truth is the scoring models used for mortgages have a two-week time frame of you being able to shop, like get this lender to pull and then this lender can pull, and it would only be considered one hard inquiry. Now, as far as the scoring models, they have less than 5% impact. You would have to, in a 12-month time frame, apply for a car, apply for a home, apply for a credit card, okay, for you to lose 3 to 5 points total. Okay, that's the worst case kind of scenario. And after 12 months, they fade out of your score. So I don't want you to think about that, but I do want you to know there's a better solution. There is now a resource available to you. I don't work for them. It does cost money, but it's the only place you can go where it's not an inquiry and you get your real deal mortgage scores, your auto scores. You get 28 of the FICO scoring model scores that they actually use for a house, for a car, because any of the free credit scores you're getting, they don't use them for anything. That's a different analytical model than what's used for buying a house, buying a car, getting a credit card. So if you go to my FICO, MY FICO, that is the one place you can go. It's pay for the advanced membership, okay, but you can also unsubscribe like the day after. You don't have to keep going with it, but pay for the 3B report, and it gives you the 3 reports side by side, but also gives you the 28 FICO scores. So you can get the free 3 reports from Experian, Equifax, TransUnion every single week for free at annual credit report, but that doesn't give you scores. And you can't just go get the free reports and then get the free scores, because the free scores don't mean anything. They have a similar range, and that's about it. So you really do got to get real. Go to the mortgage to get the mortgage scores to buy a house. We only use the middle number out of the 3 mortgage scores they give you on my FICO. But once you have that info, you can then call up 4 or 5 lenders and say, hi, here's a list of my debts and what the monthly payment is. So you can kind of manually look at my debt ratio. My FICO score is this. And as long as it's within a couple days, okay, you should be able to shop around with that score. Now, remember that every day things change. Like you can have a credit card update tomorrow because your statement closed and you were maxed out on that card, and then your score drops. And the next day you go in to have a lender pull your score, and you have different scores. So it is one of those things where when you see the scores you want to see on my FICO, move forward and have the mortgage lender pull your credit. And then you're good to go.
And Alyssa, before we take the next question, just so because I hear buyers say this a lot, can you talk about, there are a lot of sites out there that they land on where it basically says shop rates, whatever. And all of a sudden, you get pounded on by all these different lenders and things like that. One, I want to caution people before they do that, right? Because they're selling your lead, selling your information. But can you tell people, how much difference in an interest rate or the fees that are associated with a mortgage, how much difference can there be between lenders? When somebody's saying, okay, the mortgage rate is, let's just use a simple 6.5%, right? Mm-hmm. By shopping, what are they shopping? Mm-hmm. Does that mean that they can get 5.5%? Or 7% in the various lenders? Can you give them an idea?
Because we are really all pretty competitive, somewhat priced with each other. Back prior to Dodd-Frank and them changing a lot of the loan officer compensation rules, it was definitely more important, I believe, to shop around, okay, to make sure you were getting the best price. These days, I feel a little different. I feel that you should be shopping people. Okay. You should be shopping, especially if you're a first-time home buyer. There are so many little stops all along the way that you want somebody who's going to say, okay, now we're here. Do you want to do this? If you do this, this is what could happen. Okay. But if you do this, this is what could happen. The last thing you want is just to be trying to direct yourself through your very first home buying process. So I find somebody you trust, that you feel that you can be open with, that they're going to communicate, they're going to be available for you. At night, weekends, whenever it's convenient for you, and that you're really going to be able to learn something from, and you can stay loyal and build a relationship together. You'll get a lot out of that.
So not much difference in price. from
Not
one
much
lender to
difference in
another?
price, but I will tell you, it's not just going to some website and putting in your information that's going to get a million people calling you. It's just applying with a loan officer. What is happening now is trigger leads. So everybody that pulls your credit as a loan officer, if you as a consumer have not gone in 5 days ahead of time to this website called optoutprescreen.com, if you don't go there 5 days ahead of time, when the lender pulls your credit, your lead is sold by the credit bureaus to many other mortgage companies that are all looking for business right now. I had 2 consumer clients last week that they did not do the pre-screen ahead of time, and they had 20 calls in a day. Okay. So, and it's overwhelming. And what's really hard is when you've been working on a deal for somebody and somebody comes in and is a brand new loan officer offering them a lower rate and really can't get that for them. You know what I'm saying? Or there's so many different things that can kind of come up. But I always tell my clients ahead of time, if you just do it right now and you go to opt out pre-screen, then the credit bureaus can't make money off of your data. Who wants their data sold? Not me. So you go there and so
tip.
5 years, you're out of the game of having your stuff stolen. I mean, have your stuff sold.
Yeah, that's fantastic.
Yeah.
And I just had a really important thought. Oh, I just lost it again. This is what I want to say. How about, so when you're shopping lenders, guys, it may not be a big difference in, or a big variable in interest rate, maybe some fees or whatever. But what about, and you said somebody that you trust, because I got to tell you, I mean, I've talked to a couple loan officers lately, and they're all calling.
I was going to say, they're probably like banging your door down. Yeah.
Right. But they don't, I mean, they have to realize, I mean, we're sitting around twiddling our thumbs too, guys. I mean, come on, let's be honest with one another, right? I mean, you're calling on me, like I'm your savior. But what I am hearing, which is quite scary, is that some of these lenders are, portfolio type lenders, right? I mean, they're keeping the loans in-house. And, I don't know the mortgage regulations. I mean, Alyssa, that's your, lane. I stay out of it, right? I always refer people to, someone that can help them with that. But what about debt to income ratio? Because I see where a lot of lenders are going, oh, we'll let you have, now all of a sudden we're going to lend you more money compared to what you make. And before we do that, before you answer that, I wanted to show a slide. Joe, if you could pull it up. It's the one that has the breakdown in the color, the breakdowns of the percentages. Yeah, I think it's the total debt balance. That's it. Yeah, let's take a look at this, which is interesting because I want you guys to understand when we're looking at a lot of the debt. By the way, this data is pretty fresh. Yeah. I think it was just released on, I don't know, the 22nd maybe of November. Some of these reports that we're showing you is pretty fresh. But anyway, this is, number one. I mean, let's check out this debt, huh? I mean, it's just going up, 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 up. But what I want you guys to understand is if you look at this debt, 71% of this debt is a mortgage, right? And there's been rules of thumb that protect people from, getting in trouble with not being able to pay their mortgage and putting them at risk for foreclosure or default, things like that. And we got kind of, I guess, spoiled because we've been rescued over the last couple of years where we hadn't had to pay our mortgage necessarily. And hey, we could be kind of, I don't want to say forgiven, but forgiven. So what's going on? Talk about the difference in lenders. Are there certain lenders that will allow you and kind of give the audience, like, what is the typical percentage you're allowed based on what you make to actually pay on a mortgage? And then are there differences in lenders that push that limit?
Yeah, for sure. I mean, there's every lender is going to have different overlays. And you can see, I mean, FHA, going up to a 57, almost a 57%. I've seen standards that we always are going to stick to. Like people ask me all the time, what's the minimum credit score to get a conventional loan? Well, it's 620, but that's like the height requirement for the ride. It does not mean you're riding the ride. Okay. It means you can get on the ride, but we don't know if we're going to finish it out. You have to look and see, it's almost like a mixture of everything. So let's say somebody wants to put 3% down and they meet all the requirements but with a higher debt ratio and a 620 credit score, probably won't get approved. It'll probably have to be a 5% down. But if the debt ratio was at 30%, there's obviously all these different factors that are going to go into the complete automated underwriting. So just because you meet all of the requirements, you've been on your job 2 years, check, I have my credit score, check, but that altogether, your loan could still carry too much risk where they require more of a down payment or more of whatever the case. And that's where, again, you have to get sometimes creative looking at that debt. What we're looking at is there's general, guidelines, but typically when you're wanting to see, what kind of a house payment you could afford, you're wanting to find out what your monthly gross amount is before taxes, before all your bills come out, before your, wages are being garnished, different things. Like it's gross income monthly. If you multiply it by 45%, that amount is where you're going to start when you deduct then from there your car payment, your minimum payments on your credit cards, the calculation for your student loan. And then what's left is your house payment. So let's say that you, after your monthly gross and 45% of your monthly gross income leaves you, let's use 60,000. Okay. 5,000 a month is what your 12, for 12 months, your gross monthly income is 5,000. Okay. Times 45%. I think it's about 2,100. Right. And so from there, let's say you didn't have a car payment. You might, with a good credit score, be able to push having a house payment pretty close to 40%. Okay. But then if you have if you have the car payment in there suddenly, maybe that, $2,100 allowance you had for your house and the rest of your debt, now it's, $500 less. And so now the maximum house payment you can have is $1,600 for a house. And you might find out that between your down payment and your credit score and the interest rates, that $1,600 buys you something for $250. And in your market, you don't have houses that are $250,000. Then that's a problem. Okay. And I kind of went around the way for that. But as far as your debt ratio, when I see people that would love to buy a house, but they can't afford a house payment, the more that you can deduct in the credit card payment, right? A lot of people were even, when they got pre-approved over a year ago, the student loan calculation was like 1% of your loan balance. And now we have a couple loan programs that go down to 0.5%. So if you owed $100,000, that was $1,000 of your debt that was not going to be able to be used for a house payment, where now that's $500. So now that gives you the ability to have a $1,500 house payment instead of $1,000. So the more that you can reduce the monthly debt obligations, the more availability you'll have for a house payment, which then allows you to afford more house.
Let's look at this next slide.
Yeah.
And then we'll answer a question. So we have another slide here that's very interesting. We'll drop some of these links to after the show.
I was going to mention too, it said this morning that the average household credit card debt's about $89.42. So you think right off the bat, that's at least a couple $100 in minimum payments people are making on $9,000 in debt, that if they didn't have, maybe that would take them from an $1,800 house payment allowance to $2,000 house payment allowance.
Yeah, we're almost at $7 trillion in debt,
total
consumer debt.
Total
Total
debt
debt.
though, with
Yeah,
everything
that's
too,
right.
with student loans,
I
everything. Yeah,
mean, still crazy. Let's
it
look at
is.
the historical chart of consumer debt, the Fred chart. This is an interesting one too. And then I have an article that I want to show you guys that kind of goes along with this. But let's pull that Fred chart up on consumer debt. Just to give you guys some kind of an idea, when we're talking the mounting debt, and I think this is one of the reasons why we're not going to see maybe interest rates drop because we need to get prices in check all around. We need to stabilize. Inflation, just food and utilities. And here we're coming into wintertime and fuel bills and gas and everything is so expensive. And guys, unfortunately, a lot of people that I meet, and Alyssa, you may be running into the same thing, but we're seeing a lot of people now financing their groceries on their credit cards. And by the way, some of these credit card interest rates are 30%, 29.99%. It's crazy.
I think the
And we're
average is
looking
at 19. Yeah.
Yeah, 19%. It's like you're saying, you're putting minimum payments down, guys. You're never getting caught up. You're never going to pay it off. But we can look here. This is billions of dollars. This is consumer loans, credit cards, other revolving plans, at the highest. And the interesting thing, you look at 2010, we got that spike there, where I think it was March 31st or something? What was it? Somewhere around there. But anyway, let's take a look at that article that we were looking at earlier. And I don't know where it is now, but this is kind of unique. But back in 2010, we saw debt climb to all-time crazy high. And this is interesting. This was published on March 31st. When you saw that straight line go up, here we go. Americans love to spend. As consumer debt continues to grow, Americans are now entering uncharted waters, according to cardweb.com. And by the way, they have very expensive reports. A lot of news sources, cardweb.com. They're like $1,000 to download their reports. So it's very credible. They charge dearly for their data. But 43% of Americans, this is 2010, 43% of American families now spend more than they earn. Mm-hmm. Each year. Do you think, Alyssa, it's any different today?
Yeah, I tell you, I do think that what I saw the last couple of years, watching it closely, was credit card debt got paid down substantially over the last couple of years.
Because of stimulus.
Yeah, because of stimulus, because of people
It's
making
back up.
a lot of better. Also the credit score jumped more than it ever had in history. It was like pretty fun. And this year it stayed exactly the same, but we still had a huge jump. It typically goes up like 1 point a year. It had a huge jump. The other big thing is I saw
along the lines of that, not to
Yeah.
interrupt, but along the lines
Yeah.
of that, we also banked more money in 2020.
We did.
And that's gone.
I was going to say, but if you look at that lately, it's not just the credit card debt is going up. The savings has just gone to zero. The savings is like, boom. Now, here's the thing. That's why I think the mental state of a lot of people right now is complete frozen, because it's first of all, we kind of know that there is very little inventory, that we're not going to see the 2008 housing crash. I don't believe we're going to see the house values crash. Okay. I really don't. I see them tapering, obviously getting more reasonable, but I also see that this is a massive opportunity right now for every veteran and everybody who wanted to go FHA in the last few years and couldn't, because they couldn't compete. Not only could they not compete, they couldn't up with the cash difference to go over the appraised value. They couldn't even get in the door to have to pay more for the house. But right now, like I say it all the time, veterans, you're getting no down payment. You're getting repairs paid for. You're getting your closing costs covered. They can even cover some of your old debt, your old bad debt that has to be paid off. So I also think, like, look at all of the ability for anybody out there who wanted to use government, FHA or VA financing, that they actually have a way to get in here and get the house and then refinance it. But you do have to mentally, like I said, people are going to have to shift their thinking into having more of their monthly budget going to housing in general. Like I said, that shift of going, oh my gosh, I'm 45 and I can't even imagine having a $3,000 house
I can't
payment.
afford food.
But I'll tell you what, though,
get back to
here's what's
ramen noodles.
interesting. My father is stepfather. Sorry, getting confused with the dads here. But my stepfather he's retired, but he does Uber Eats. And he said, you know what the number one Uber Eats, like DoorDash call I get is for coffee drinks to an apartment complex to somebody who's 20 to 30 years old. I'm like, oh my gosh.
I'm not going to buy a house that way.
Because you're spending $1 billion on coffee. And I'm bad. I know, but you got to find something else. We got to find another way.
Let's take some questions.
The storage unit too. Storage units, you guys.
Units.
Do you need it? I mean, that's $200-$300.
Yep.
Sell it.
Yeah, sell it. They suck your money for sure.
It's the little things.
Yeah. Danuska, Todd, Melissa, and Alyssa, good evening. Is it easy to refinance a house for a better rate if the value depreciates by 15%?
It depends on the loan program. Okay. So you'd have to let's say that you're somebody who bought your home in 2019. Okay. It's almost like you had an apple you bought for 50 cents. Someone last year told you it was worth $400. And today it's worth $100, so it kind of depended on where they started from, Now, if you just bought your home from any time, I'd say from September 2021 to now, and you didn't put, maybe 3% down or 3.5% down, it's going to be a little while. You're not going to see. I mean, I say anybody who put 10% down on their purchase in this last year, you're okay. You're probably evened out right now. But there's going to be options to refi. I would focus mostly on credit score to get yourself in the best prep place, because like I said, if your only option is to go FHA because of your credit score, it's not going to provide you all the options that others would have. So credit score, like I said, is so key.
Yeah, Danuska, thank you. We appreciate you. And we're kind of curious to see whether you closed on your house or whether you're about to. I know you had an inspection and you were kind of going back and forth. But along the lines of this, let's talk about the person that bought a month ago. And maybe they bought at 6.25. Mm-hmm. And then rates drop to 5.5%. Right. Chances are you're not going to do it, right?
Well, if you have an FHA, it depends on how long you plan to stay in the home. Sometimes I have people that are so dead set on wanting to refi. And I'm like, why do you want to refi so bad? And they say, well, because I want to get rid of my mortgage insurance. I'm like, okay, but with what you're paying with your interest rate and your mortgage insurance right now, if you refi and you go over to a conventional loan that doesn't require mortgage insurance, the rate's higher. So the combination of what you have together, moving over to for what purpose, some people just think they want to refi because they think it's going to save them no matter what, but not in a higher interest rate.
And that's why you need somebody that you can trust, because is there a loan officer that may do that? They may do that deal. Yeah, absolutely. Where somebody else may advise them not to.
Yeah, absolutely. There's a lot of people out right now that don't have that conscience. They're just going to tell them, and they're somehow inside of them, they're going to say, it's okay because I'm helping them get what they want. And that's not always, enabling somebody is not always helpful.
I think it's important, though. Todd, I know you're going to talk right there, but this is what you guys were just talking about. Is it possible the bad loans are being written today? How are people surviving in today's economy? What are these people who are strapped so thin going to do when life happens to them?
Mm-hmm.
Yeah, Jeff,
they don't have
you're
that savings.
So true. So this is what concerns me, I think, more than anything else. And, for a lot of the people that bought in the last year, that waived their inspection rates,
Mm-hmm.
and now they're having their heating and air systems go up and major components.
Yeah.
Yeah,
But see,
I mean,
that's
it's
something else that I've had is like a lot of people that have said I have a 2 or 3% interest rate, FHA, and I'm not going to go up to 5 or 6%. But they're also knowing that they have to get a new AC unit, a new roof. How are you going to pay for that with a credit card? That's 20%. That then
Yeah.
will lead you to your credit score dropping. Oh, then your insurance becomes renewed off the new credit score, and before you know it, your whole budget on everything starts going up, So it's about forward thinking. And sometimes it does make sense to even to increase your rate, but to maximize what you can do. But like I said, if the rates were to drop down a point from where they are right now, somebody next year who wants to refinance, and let's say they could go into conventional, if they bought a house for, 350, 400,000, in a year, the mortgage insurance going away is about equivalent to what 1% in the rate would be. And like I said, that some of them will have options to not have to get an appraisal at all.
Mm-hmm.
They're not required for some of them, loan programs. The conforming loan limit went up today. Did you know that? We didn't talk about that, but I do want to make sure we state that, because that's crazy. This is crazy if you think about it. Okay. It went up today to 726,200. But just remember, from 2007 to 2016, it was 417,000. It never changed, right? Then it went up a little bit, like to 423, then to 454, like deek, and then to 647,200 for the 2021 year. And then when 2022 came, I'm sorry, that was for 2022. And then now for the 2023 year, we're at 726.2 in most areas. In the higher cost areas, 1,089,000 is what your loan amount can be in Los Angeles and New York, which is crazy to think.
Where people are losing their jobs.
Yeah, and to think that's about a $30,000 to $40,000 down payment on a $1.1 million home. That's what's required. 3% for a first-time home buyer. Yeah,
ridiculous.
It's buying $1 million home. Yeah, but it is a big, huge jump, and we have not seen the income jump with it. Now, people are doing 10 different side jobs, to make up for the fact that their one employer has not increased their income. So now they have 12 other jobs and, doing a variety of stuff that you can't even document to give them more income to buy a house. But that's the only way I can think of that people are really making it right now. Coupons only go so far. And so you're having to go through and really figure out either, could I rent out my pool? Could I rent out my storage space? Could I rent my dog?
Rent out your pool.
You can. Swimmingly. Yeah. I can't even imagine people like swimming in my pool. I'm like, what are we doing here? You guys want some
coming
music?
to your house?
Yeah.
Having a
But
party.
I have had people ask me about my storage space too, though. But I've seen people buy cars and rent them out on a daily through Turo. But people getting creative, that's for sure,
Yeah.
Line of credit. I would tell you another good suggestion is like, if you do own a home right now, you don't know what the values are going to do. They would eventually like suspend certain lines of credits down the line. But if you have the ability to go right now and set up a home equity line, okay, here's the thing. If you lose your job, you can't go set up a home equity line to access the equity in your home because you don't have a job.
No income, no loan.
Yeah. So if you get the equity line, you don't have any fees usually. I just got mine set up through B of A and it took a few months, but I will tell you, like, I don't have a single fee I'll pay unless I need it. But if I need it, I can access it. That's a big thing, I think, in America.
Alyssa,
can't access.
Let's talk about that. Let's talk about the different kinds of either a credit union or a bank, a commercial bank. Are credit unions better than commercial banks?
No, I don't think they're better. They provide different services, and some I think are gonna. If you're a pretty vanilla person, you've been with your credit union for a long time. Sometimes that's where you just feel most comfortable. But they often have overlays. They often want very vanilla, nothing outside the box. My opinion is it's best to go work with I'm a mortgage banker. which is similar to like a mortgage broker, except for we use our own money to fund the loan, but I do shop around and we work as a correspondent with many different banks. And that's a big deal because right now too, you have to be very careful with not just deciding to, let's say that you are shopping around for lenders and you find one with a bank that I'm just trying to think of a bank that just closed recently. It's it starts with an S and I can't think of it. But like, say you get, all set up and you're ready to close on your loan and suddenly the bank closes their doors.
Mm-hmm.
That's happened a bunch in the last few months. And we're going to see more of that over the next few months. So you have to be kind of careful that you're working with a lender that is going to be at a bank that's going to be open tomorrow, that has the ability to fund your loan and not show up, ghost you.
We've got a question here. Scott Walter, someone who we have podcasted with, Todd has podcasted with, and we admire so much. So thank you so much, Scott, for your question. But this is big. I mean, what happens to the 10 million people who bought in a crisis at top of the market and the house is no longer worth what they paid and they can't sell for what they owe as inflation layoffs are now spiking?
And before we get into that, Scott, I want to say hello. Thanks for chiming in here. If you could take a minute after this podcast, note Scott Walters here. Check him out on YouTube. He's got a great show. What I like about Scott is he is a fellow real estate agent. The guy's in the trenches every day doing this stuff too, out in California. And check him out. Thanks, Scott. Appreciate it, buddy.
It's a good question too. And the thing is what I've been saying to a lot of the people that have even bought this last year, there's a difference. There's a difference with buying real estate and turning it, every couple of years versus, buying it and you're going to stay put for probably 10 years, So I do think that there's going to be a lot more people staying put, but yeah, the forbearance numbers have gone down. There's fewer than last month homes that are mortgages that are in forbearance, but there are a lot more workout programs than I've seen than what was offered back then in 08, like during the crash and everything. They were letting people go right to foreclosure, where I do see a lot of people right now who pick up the phone and say, I can't make my next payment, and work out some different modification programs.
Let's talk about that. I want to shout out to Sprout Mortgage. So we have Travis from Real Estate Mindset while we're talking about our fellow YouTubers out there. And he's also a loan officer and does a great service to bring real estate information. Travis, we appreciate you.
He was mentioning Sprout, though, was the one that closed down. Yeah. Yeah,
Sprout. Yep. But anyway, so and kind of talking about that last question, because I think, and this is where a lot of, it's kind of crazy because you want to be positive and you want to talk about good things. But at the same time, I think it is our responsibility that are professionals in an industry that is collapsing right now. I mean, it's, we are experiencing a big downturn. And, part of our role as professionals is, we're in the business. Alyssa, she's in the business. We've been in the business for more than 20 years. This is a long haul. Do we think it's going to be a big crash like 08? But I think that the big thing here, guys, is that we need to be very mindful of the amount of debt that we are incurring. And when Scott is talking about layoffs, these are real. We're hearing companies, and we publish a lot that talk about, Amazon, 10,000 people, FedEx closing offices, all these different things that are happening around our country, the tech industry that's being affected. And then, we always get the people that say, yeah, but Amazon hired so many people because so them shaving 10,000 is nothing. The problem that we have is these people that were hired have bought houses, have incurred debt or increasing, consumer debt. And so the bottom line is it is affecting us. So when, Scott's saying, what about these people? I think that, if you're looking to buy a house right now, or maybe you've already bought a house, you need to start thinking about, how do we reduce your debt? How do we get you, preserve your credit? Like Alyssa's saying, how do we reduce the amount of debt that you owe? How do we get rid of the things that you don't need and focus on buying down those loans or buying down those mortgages where we're looking at interest rates where you're not making 6% in a bank? How can you save more money to dump that into your 6% mortgage loan and start buying down your loans and things like that? So if rates do dip down, you have an opportunity to refinance. So when we come on and we're starting to talk about a lot of this on our channel and a lot of things that are going on, we're not trying to be pessimistic. We're not trying to, just be alarmist. What we're trying to do is educate you as a public body and say, guys, we are in for turbulent times. If y'all haven't realized that, you should, right? And so that's what we're trying to say. Let's answer some more questions.
We got Travis, real estate mindset. How valuable can it be for someone that is rebuilding their credit to become co-authorized on a credit card in good standing?
Good question. Because most people would say that's a great idea, but they miss something. So when you get added on as an authorized user, it's almost like they're letting you borrow their best football player on their team. Okay, let's imagine they have a team of players and then you have a team. Your team makes up nobody. You have nobody on your field whatsoever. Okay, but they let you have one of their credit cards. Okay, so that guy is now part of your credit score, right? That one account, not all of the history that mom or dad, whoever you're getting the authorized user or, card from. But the key is that most people my age and older were never taught that what goes on to the credit report, which then gets fed into the credit scoring machine, is what your balance and limit was only on the last day of your credit card statement. If you don't know that, then think about it. There's 30 days of the month. Okay. You're taking the card out, you're buying dinner. The next day, I'll pay it off on the app. By the end of the day, you put airline tickets on it. The next morning, I'm not doing anything with it today. 2 more days later, then you pay it off. You don't know the one day, which is usually about 5 or 6 days after your due date, when your statement closes. Okay. That's the day they print the statement. What the balance was on that day goes on the statement, gets mailed out to you, right? Or comes through paperless, and it gets sent up to the credit bureau for the one time for the month. It's not going to change until next statement closes. So think about how many people pay off their credit card in full on the due date. And then the 4 or 5 days that follow, they bring it right back up to what that credit limit is. Now, if that balance and limit reflects more than 10% of the limit, so whatever the limit is, drop the last zero. If your balance is more than that on the statement closing date, your credit scores are going to suffer. They're not maximized. Okay. Most people think 30% is what you keep your cards under. 20% is what you can. It's 10. So they're talking about other scoring models that, that are free and they don't matter. So the rebuilding their credit. So what happens is as long as you have somebody who's going to add you on as an authorized user to a credit card they've never been late on, they know what day the statement closes, and they're willing to make sure that balance is just $20, something between $1 and 10%, not a dime more, to help you rebuild. Okay. Otherwise, if you're somebody who's in a rebuild place, that's different from not having any credit whatsoever. But if you're in that build or rebuild place, every player matters. And what they actually demonstrate on paper is it's demonstrating how disciplined you are with a financial decision. I gave you 500 available. You borrowed 20. Now, if you just willy-nilly it, okay, the algorithm will not, for a car, for an auto loan, it's not going to maximize your scores. Okay. You got the credit cards are probably it's the most important thing next to just paying your bills on time is what is the credit card balance and limit on the last day of closing of the statement, just on the revolving accounts.
I have a question for you. So, somebody's looking to buy a house. What do you feel after their down payment and closing costs, out-of-pocket fees, when they buy? What do you think they should have as far as cash in the bank for emergency funds? How many months?
I say 6 months. 6 months of house payments is a good place.
Just
Most
house
people will
payments?
say 3, like 3 to 6 months of your house payments. Everybody's going to be a little bit different on the way that they go about it. But I can tell you,
Let's
people
talk
not
about the
walking
buyers
in.
right now. How many of them have that?
Yeah. And think about how many have lost quite a bit in stock market, crypto, other investments.
Yeah.
There's not a lot, of ways. Now, what I know is that if you Google peer-to-peer lending, there's more places for you to get money. Okay, get cash. Now, if you were going to use that money to buy a house, you'd have to wait several months because you're not allowed to have a secured, like a loan be used for your down payment, right? However, if that loan's on the credit and that money's been sitting in your bank account for more than 60 days and we're counting the payment on that loan in your debt ratio, but that takes a few months for it to go onto your loan. There's ways you're still going to be paying a monthly payment on the down payment you're going to be using for your house. Talk about leverage, but there
Yeah.
are at least like a few more options. We're definitely seeing a lot of wealth being inherited. I had a few people last year that bought homes with their the GameStop stock money they made, things like that. But yeah, I see a bigger issue as being like taxes too. I see a lot of people that are behind on taxes and have a lot of extra income, extra jobs that they need to get cleared up.
Mm-hmm. Are you seeing out of a lot of the borrowers or the people that are applying for loans, are you seeing a lot of longevity on employment at a specific employer? Are you seeing that there's a lot of jumping around, job jumping?
A lot of jumping around, a lot of shakiness. Like I said, a lot of people that are held back, they've actually got their credit score up. Like the CIA, they've got their credit, they've got their income, they've got their assets, but a lot of them, the income piece is really messing them up. And you think about how many people went into business for themselves over the last couple of years, right? Well, the first couple of years of taxes being self-employed, you're not really even showing much to begin with. But if you are showing a lot, then you need to be paying a lot in taxes too. And a lot of people don't factor that in when they're going to set up a payment plan with the IRS and having to have that payment added into the debt ratio as well. I see more people looking into multi-family homes, looking into the 2, 3, 4 duplex, something that they can live in one of them and rent out the others. I see a lot more people starting to document what's called border income. Like, let's say you got a boyfriend who lives with you. He gives you $500 a month towards the bills. He's going to move with you to the next house. He just doesn't have good credit, He's not going to get his life together. Well, if you start documenting that you get $500 on the first every single month, and it's not more than 30% of your total income, you can use that when you go to qualify. Yeah.
That's good tip, guys. Because I see a lot of times where there is a single borrower or somebody that wants to be a single borrower and they don't make enough. I mean, like Alyssa had said, they qualify for the salary that they make. They can't even buy a $250,000 house. And in the area where they live, they just don't exist. Or if they did, they wouldn't be able to get a loan on it because it's deplorable. So what happens is they ask, if I have a roommate, if I get a roommate. And I think what Alyssa's saying here is, a lot of it is in documentation and, and being prepared. And if you're thinking about maybe trying to buy in the spring or whatever, so let's just say, along the lines of that, if you are living in an apartment and you have a good job and you've been there 3 years or whatever, and you have a roommate and the roommate, maybe you're the primary one on the lease, but your roommate is contributing that $500, $700 a month. What you're saying, Alyssa, is how many months of that?
12 months
12
of
months.
Religious, like having minimum 9 months. But if it's 9 months, they're going to still, spread it out over a 12-month period.
Yeah.
Okay. And again, like it can't exceed 30%. It's a perfect situation for somebody who's making like 60,000 a year
Mhm.
and they need to qualify for something that's 350 to 400. And they
Yeah.
really just need, about 30,000 more in income, to
Mhm.
get there. Then it works out really good. But I have
You
a
said
lot
it
of
can't be any more
adult
than 30%.
of the total income
I
being
got you.
used.
Right.
Yeah.
So if
Now
you
I
make
see a lot.
60,
Yeah.
yeah. Okay. Yeah.
I'm seeing a lot of sons and daughters that moved home,
Mhm.
moms and dads. I've guided a couple moms through making sure that, it's coming straight from Junior's bank account in his own
Yeah.
name, not mom's, and coming directly in on the same day every month. Same thing
Mm.
with co-signing on like a lot of people will go co-sign for a car for their kid and think that they don't have to count that into the debt ratio because my kid makes the
Mm.
payment. Unless you can document it with 12 months of them making the payment on their own, not on an account that's both your names. They can't have one late payment in that 12-month
Yeah.
period for you to, and then you don't have to count it
Mm.
into the debt ratio. But there's some requirements.
Yeah.
So
There's some great tips, guys. I mean, we could talk all night. Guys, and we'll answer some more questions here, but as we wrap up here, probably another 10 or 15 minutes. If you guys are enjoying this video, you like Alyssa, hit the thumbs up, let her know. It'll let her know
yeah,
that you appreciate her
thank
advice
you.
here, her tips
Mhm.
tonight. And we love having her on the show. She's a very, very valuable asset to our
Thank
team
you.
here. And and a great contributor to our channel. We don't always see eye to eye, with everybody, and the differences really come down to nobody has a crystal ball. And when we're saying we don't see eye to eye, I mean, we're talking about interest rates or this or house prices or whatever. And again, nobody knows. I mean, we're all in this trying to strategize, trying to work our way through. But I want to leave you guys with a couple interesting things before we answer some questions, because, I've been thinking a lot in my mind about, what is going on in the economy overall, and trying to read some good books on some basically currency, fiat currency, gold standards back in the day, Glass-Steagall Act. I mean, guys, these are things, if you haven't really looked into things, when we're trying to understand, the financial position that we're in right now, and there's a lot of talk about, are we going to see, some type of financial collapse? Are we going to, where are we going with all this? Because we are in some very unique times. And when we start seeing, people like cryptocurrency and the way that people are getting wiped out, and the billionaires that, and now they are broke, they're flat out busted. And we're talking about real estate, which is essentially part of the financial markets, right? I mean, sometimes we like to think of real estate as historically permanence of investment. The question is it going to be that way in the future when we're looking at, big companies buying up houses as fast as they can buy them and things like that? But, it takes me back to, thinking about how deflation has been successfully used in our, in our ecosystem, our economy, and how things have come down in price except the necessities of life, right? And what is interesting to me, and where I'm kind of going with this is, guys, if you think about how expensive a TV was, when a flat screen TV came out, and I think, Melissa, you said you bought a nice TV for $80 over the weekend or something,
did,
and how prices have come down. But we have gotten smarter in technology. We've gotten more efficient in the way that we live and work and make things and trade around the world. Why is it that? And, maybe you all are smarter than me, but why is it that with the technologies that we have, that we can't get the prices down on these things? Houses, food. I mean, certainly I think we can grow a chicken faster today than we've ever been able to grow a chicken and get it to the shelf. What are we doing, guys? Why aren't we, what's happening with our economy? But I want you guys to think on that for the next week, but let's take a couple more questions. That's kind of a big drop, wasn't it?
It's what I mean. Yeah. We should all be thinking about this stuff, especially
working on something here.
Yeah.
It's a pretty big deal. Yeah.
Diane, thank you so much for your question. Why does this bank keep asking for, I think it's meaning to say, a counter offer? 2 weeks now, yesterday, emailed my agent asking if I can up to the closing asking price. Why is this foreclosure bank keep doing this?
So it sounds to me like the house that she's bidding on, the bank owns, and she's probably waiting because there's a lot of disorganization at that bank. I really can't tell you exactly why, but I do know the process for a short sale or foreclosure or anything, it's going to be a little bit longer because you're dealing with a bank.
And we deal with this. Yeah. And we deal with this a lot. And what a lot of people don't understand, and when a bank takes back a property, it becomes an REO, which we know in the industry, which is real estate owned. Number one, guys, banks don't want to own real estate. Okay. They're not in a real estate business. They want the borrower to pay their bill on time. Right. And that's why they're trying to work out as much as they can so that they don't get stuck with this inventory. They're looking at it right now. The banks is, hey, you know what? If somebody's not paying, if we can do some kind of a modification right now, they probably have equity on the house. The equity drops on the house below the point of what they owe. The bank's hand is kind of forced in that case, and they're going to foreclose in a lot of cases. And now they own the property. They list the property on the MLS, and then they get lowball offers, usually from a lot of investors, because when people stop paying their mortgage payment, they stop fixing things. And it takes such a process. So usually by the time it is foreclosed, the bank gets it back. It's probably not in great shape. So investors take a shot. They think the bank is going to accept. They go, well, it's only worth this much money. Guys, they are only going to discount it a certain percentage of what they are allowed to do or permitted to do by their guidelines. And the only other thing that they wait is time. So what happens is it's either going to not sell as they're incrementally lowering it, very low percentages at a time, and somebody's either going to come up to the plate and buy it, or it's just going to sit on the market forever. They'll wait. They'll hold it. You can't come below whatever that percentage is for that lender. They'll just reject it and say no. So when they're asking you to get closer to the listing price, they're saying we can only authorize a certain percentage within this price. If you don't hit it, you're rejected. So that's what's happening with these lenders.
How about this one, Alyssa? Is it true the more money you put down, they will give you a lower interest rate?
Not always. I mean, it depends on, it's funny you say that, because I was just doing a loan today for somebody who immediately said, I don't want mortgage insurance. And I said, okay. But she wanted to put 20% down, and she has a great credit score. So 780 plus. I told her, actually, when you look at it, at 15% down, you get about an eighth better on the rate, because there's a little insurance there, right? A little less risk. So they give you a little better interest rate to put 19% down instead of 20, right? So you have a little bit of mortgage insurance, but it's based on every 5%, your mortgage insurance factor drops greatly. So for this client, she had to pay $1,013, and she bought out the mortgage insurance for life. So no mortgage insurance. She got an eighth better on the rate. There's ways to work that. I hope that makes sense. But yeah, you've got to be more creative. But no, they're not typically going to give you a lower interest rate if you put 20% down versus you putting 3% down. The difference is in that mortgage insurance.
How about this?
Great question.
Increments, yeah.
Great question. Great answer.
Thank you.
We've got another question from Danuska. Alyssa, paying a little more every month a mortgage, is this the best solution for the current high rates?
Well, if that wouldn't be in your case, like if you have a mortgage to make a little extra payment on each month, you're already locked in. So your rate doesn't change with the market. You probably got in a lot earlier. Am I following that? But as far as paying a little bit more, I see this all over the place on TikTok, on social media, where people make videos, or parents are telling their kids, I make one extra payment a year and it cuts my loan down to 17 years. First of all, it's not that much. It's not down to 17 years. And you really do need to just Google an amortization calculator. And that way you can put in the loan amount, and you can put in your rate, and you can put in, what if I made $100 extra a monthly payment? What if I made this much extra a year? How much would it, how fast would it pay my loan off? So definitely take advantage of that. But don't ever take it upon yourself, where I see a lot of people where they break up the payment into 2 payments where they pay biweekly to try to make that extra 1 payment at the end of the year. But they don't do it through permission of their servicer. They just start doing it. And then they're like, why did I get a 30-day late? And they're like, well, they got half the payment and then half the payment without even ever agreeing to do that with you. So don't just set that up on yourself. I've seen people make a big mistake getting a 30-day late, not being able to get it off. But if a servicer offers you directly, not a third party company, never go through that. But if they do offer you some sort of biweekly program with the servicer, you can look at that. But look at your little amortization calculator and play with it. Every extra little bit that you can tack on, especially on those credit cards, it's going to pay it off so much faster.
But if you don't owe the consumer revolving debt, you pay that off every month, and you're excuse me.
Yep.
And you're in a position where you can, if you're at a 6.5%, I mean, correct me if I'm wrong. If you put the extra money down, you're making 6.5% on your money.
Right.
I mean, right. I mean, if you were to put the money in the bank and get
right
a 3/4% interest rate, but you can put that extra cash down on your mortgage at 6%, you're making 6% on your money.
Kind of. That's
how is that not kind of?
I don't want to look like an idiot. And like,
if you're paying, I'm just asking. I'm just saying, if you're paying down principal, if you're not paying down interest, you're not paying extra into your escrow. You're paying down your principal balance.
Yeah.
You're putting money essentially in the bank.
Yeah.
If you're paying 6% interest on your principal loan on an annual basis, and you put extra cash down, you're making 6% on your cash.
Yeah.
If I have extra cash, I'm going to put it down on my 6% loan. If I have 3.25%, I may say I can make more money than 3.25% on my money. I'm not going to buy down my mortgage. I'm going to put it in an investment, or I'm going to buy an investment property. But if I have a high interest loan, because here's the thing, you can refi and you can always take cash back out as long as you keep your credit good. So, if you have equity in your house, you need the cash. Huh?
Yeah. I've seen a lot of people get stuck not being able to get back that cash if they lose their job, if they lose their income or ability.
Right.
Yeah.
There's risks.
Yeah. You got to be careful. I know I did a 15-year and I had a lot of, I would never normally suggest that unless 100% you're on a game plan to pay your house off. Okay. That's 100% it. And because guess what happens if you can't make the 15-year fixed payment, but you could make the 30-year fixed payment, but you can't make
they take your house.
Yeah. Now, a lot of people, do you know how many people, there's more than 49% of America have mortgage free, don't have a mortgage. Okay. But you think about it, so if those people can't make their taxes and insurance payment or whatever other, and if they did lose the house, even if they have the equity in Arizona, a lot of them, if you don't claim that equity within 3 years, you can't go back and claim it. And it's kind of a process. They don't really make it clear that you have equity in the home to get. And some people think if they lose the house, they lose the house, but they still have the ability to access that equity in the house. Yeah. Crazy.
I do think
I have a question for you, Alyssa.
Yes.
Talk to us about the Arizona real estate market. You guys are predicted as one of the markets in the country that may see the biggest downturn. You saw one of the biggest upsides, and there's a lot of talk about prices in Arizona. Are you seeing it?
I'm not. I'm seeing what I'm seeing is like a frozen community. Okay, so there's not really many. At least from my eyes, I'm seeing a lot of consumers that I talk to, realtors I talk to every single day, that are just like, boy, it's quiet. They're finding ways to kind of generate excitement, and there are people out there that are ready to buy. They're getting through the holidays. They're getting through wanting to feel a little bit more of a trust that their house isn't going to plummet. They feel pretty good that it's not going to completely fall off. But, open the news. It doesn't take you 2 seconds before you're kind of in a bad mood because everything that's fallen apart and everybody's predicting that's like some big person, that the world is falling apart. I mean, so I think we're all kind of like, watching. We're all slowly like watching and trying to get things to back up our beliefs in our head about what we're seeing on a daily basis. So I don't, but in the Arizona market, like I said, we went up. We went up like our apples were worth millions of dollars last year. So they're going to come down a little bit. I saw certain pockets out here that, like I said, were big iBuyer zip codes that, they're definitely dropping 100,000 after, in price after 60 days. So it's just like
100,000 on what price?
In
price
the 5 to 600 range.
20%. You're seeing 20% price drops.
Yeah. So big drops. But I also know that there are certain, after doing a lot of exploring across the country, it's interesting how much the extras play into housing affordability. If you bought a house in Texas where the property taxes, my buddy who lives in Austin, he's using 2.1% for his property tax factor, right? It's about 3-4 times more than us. And New Jersey, they're crazy. So in other words, what a normal person here in Arizona on a $400,000 house would pay on property taxes is maybe $2,400 a year. You go to New Jersey and some places like
Maryland,
they're paying $38,000 a year. And so think about how much of that housing payment ends up getting eaten up with property taxes.
But I think about the people that bought the house 3 months ago for $500,000, and now the house next door is selling for $400,000.
Right.
That's what I really think about, because when I remember 2008, I remember, it was bad, right? I mean, it was terrible. I mean, what am I saying? It was terrible, right? I mean, it wasn't just housing. I mean, it was like a fallout, right? General Motors went to bust, bankrupt.
Yeah.
But here's the thing. I know a lot of people that stopped paying their mortgage payment because the next door neighbor bought their house for $100,000 less. So they just decided they weren't going to pay their mortgage.
But I don't feel like we're in the same place as them, because for one thing, going into the last crash, it was 10 years of not having to prove people even had the ability to repay. They were teachers stating they were making $10,000 a month. Okay, so first of all, you couldn't afford it to begin with. Then you got on a loan program where you could afford it if you were going to go neg-am every month, be on a 1% payment plan. The other thing was you didn't have much skin in the game. So the difference now, people have a lot of equity in their home. They're not walking away. There's not an alternative where they can go rent for cheaper. You can't. So
you just said the house prices are dropping $100,000.
Oh, no, I know what
equity,
I'm saying. But I'm saying the people that your neighbors that would normally go, oh, I'm out of here, I'm walking away.
Yeah.
They're not, because they afford their home. They had to prove they had the ability to repay, and they have equity. Okay. So if my neighbor now loses his job down the street, well, the 7 of us, we all have equity in our home and we still have our jobs, and his value went down a little bit, but none of us have to sell, right? The difference was in 2008, every single house in our cul-de-sac couldn't afford it. And we had no skin in the game. In Arizona, they were like, walk away. They can't come after you. We're an anti-deficiency state. You're going to walk away and maybe have a little scrub on your credit report. You'll rebuild again and you'll be fine.
They're going to see you and you're going to help them build it back again.
Yeah. So it's like, I just think you had nothing to lose, back then. But I also know the inventory was crazy. They way overbuilt during that time. And we're not in those same conditions right now. We just don't have that. So, but yeah, not everybody's dropping 20%, but what I'm seeing is in certain areas, like some of it depends on how much they want a fire sale, Yeah. And whether it becomes just an anomaly, like the one in the neighborhood that's like that and the rest aren't, which they can kind of set aside, or everybody starts following suit,
Yeah.
What do you think about that rental software? Did you read that thing about the rental software that basically got every property development? Yeah, to increase the rent. Ooh, that's going to be a story. Just wait.
That is going to be a huge story. And we're going to see CPI on rent go nuts too. I mean, we're looking at data that's 3 months old on a lot of this rental stuff. I mean, I think we're going to see, that's why I don't think rates are going to come down. I think that we're going to see real CPI come out that is going to be reflected. And by how they do CPI, by the way, I don't even want to get into
but
that.
remember, the core CPI came in lower based on all the analysis. They were saying last month, if the core CPI comes in slightly lower than where it was in September, we will see the rates drop in that high, low fives, high fours, because they're about 2%. Anyway, I'm not going to be all technical here, but yeah, it sounds from everything that we expected to happen, then laid out over that next week. Yeah. Inflation got a little bit better. The rates got a little bit better. Anyway, we're supposed to be on that road.
We'll see if it holds out.
Yeah.
Well, we appreciate you. We thank you so much, Alyssa. It's so much fun. So good to see you.
So good to see you guys. I love talking to you anytime. So anytime you want to talk, call me.
Any parting words there, Melissa?
I mean, everyone is so appreciative, Alyssa. You're going to be able to read back over the comments, but very thankful, very high energy, very informative. So it's been a great show. And thank you. Thank you.
Thank you, guys. Thanks for having me.
Yeah.
We thank you guys, and we hope to see you again next Tuesday. We appreciate your time tonight. If you like the video, hit the thumbs up. Let everyone know that you did. And guys, we always appreciate when you subscribe to our channel. It'll let you know every time we go live and every time we upload content, all real estate, anything, everything real estate. Guys, until next week, see you soon.
Bye-bye.
Bye.